Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature, none of it should be relied upon as any form of personal advice. FP Markets does not know your personal scenario, nor your personal financial goals, and therefore none of it should be relied upon as any form of advice at all. Let's do a proper review of what happened last week, because there is a very clear difference between those that can communicate and those that can't. And it really is down to the three different central banks that moved policy or didn't move policy last week, and it's been building to it. Start with the Fed. They have been communicating incredibly well. In fact, you need to actually give Jay Powell a big pat on the back, considering how well he has communicated what is going to happen around their quantitative easing programs and other abnormal policy, along with liftoff and moving of the actual federal funds rate. As we said in September, we saw the liftoff start in November. It's at $15 billion a month, which is what was also expected. $10 billion in treasuries, $5 billion in mortgage-backed securities, continuing each and every month until it finishes. And therefore, all of that was known by the market. There was no major disruption to how trading happened. There was no major disruption to the US dollar. The only thing you could probably listen to is that they were very strong on the word transitory and what it means to them. And I think this also actually helped their communication. Transitory to the Fed means that there won't be any long-lasting effects to the inflation around the US economy over the longer period of time. Transitory does not mean something short-term or short-term in time in nature. That clarification certainly helped. It certainly makes us now understand that basically the COVID crisis is the transitory problem they allude to, and that it will one day filter out, and we have time on our side. That also therefore pushes back the idea that liftoff could happen in August or even September next year. Most people now believe that if it's going to happen next year, it'll be in November or more likely December. So all that gave you a little bit of optimism and probably explains why the markets, particularly equities, jumped on board. Then you've got the other two. Let's talk about the RBA and also the BOE. The RBA needs to have a very good look at itself. As I said last week's video, it was embarrassing to see them lose control of the yield curve control mechanism that they put in last year. Yes, in the statement last Tuesday, they said that they were abandoning it and it was no longer needed. That's not good enough. The fact they didn't communicate to the market at all meant that this chart, which I've showed you last week, and then an extension version of it, shows you what happens when you don't have that. That complete loss of control meant the Aussie was all over the shot. The idea of where rates were going, again, all over the shot. All of that meant that the understanding about where the RBA stands is still very cloak and dagger. And although Philip Lowe clarified that rate movements in 2022 is basically impossible, the market's still pricing it in. And that is an interesting thing. His comments did, however, take a full cent out of the Aussie. It's very hard now to look at what the Aussie US will do, or even any form of Aussie pair. And for that reason, it's making it very hard to understand where they're going. Finally, the BOE. And in terms of the BOE, their communication has been one thing and their actions another. It has caught most off guard by what they did on Thursday. They had been very strong on the idea that inflation, being at several decade highs, probably needed to be reined in. They were probably 50-50 in terms of that view. And considering that the chief economist had been strong on that idea that they needed to move on rates, that not happening on Thursday because, in their words, the issue around furlough, the issue around employment, that their path to recovery is slower than expected, and their overall uncertainty is there, to give a vote of 7-2 on rates and then 6-3 on quantitative easing to hold it as is, caught everyone off guard, because that is not the actions of what you were expecting with all the voice that was coming beforehand. That absolutely savaged the pound, and I think the BOE has lost the most amount of credibility out of all of them in the last week. It's gone from 136 down to 134 and still falling. Look at their bonds too, it got absolutely savaged off the back of it. And that is why going for the next 6 weeks, communication is going to be key, because we will get one more bank numbers from all of these three. And clearly the one to watch is the Fed, because they're going to give you the clearest outcome.